Hey everybody, Mike DeSappoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Friday, October 21st, 2022. Hope you're all having a great week, and we are back to update you on all things markets and economies. So we continue to work through unprecedented times here, right? Volatility in the financial markets are exceptionally high, and now we throw earnings season in there to boot, just to give us more data and economic indicators for markets to react from. So at this point, we're still in the early innings of earnings season. Probably about 15 to 20% of companies have reported thus far, and results have been pretty good, actually, surprising many analysts. Okay, so the backdrop going into this earnings season is that most financial analysts think that earnings are going to fall off a cliff, right? And the market has priced in a level of earnings decline that we're not sure that we're going to get. Okay, now again, in early stages, we're only through about a fifth of companies right now for S&P 500, but we've seen some pretty good results. Okay, we've seen some pretty good results. Companies holding up their margins, hitting or at least meeting revenue estimates, and most importantly, future guidance is not all that soft. So we still have a ways to go. We'll hear from all the tech titans next week. You'll have Apple, you'll have Amazon, you'll have Alphabet, you'll have Meta. And obviously, that's a couple $1 trillion of global market cap, so that'll give us a good idea as far as where directionally the market should go in the short term. Let's take a look at the market real quick. Here's the NASDAQ 100 index. Okay, really not a lot has changed, but we've seen some really outsized moves over the last week, some historical type moves. Right, so going back 8 days ago, last Thursday, we had that really bad CPI number. The market opened way down, about 2.5%. And then rallied 5% intraday to close significantly higher. The day later, we didn't get any follow through. Last Friday, that is, right? Markets sold off. This was last Friday right here. We opened higher and sold off all day. And that's really a trend we've seen on Fridays here in 2022. Specifically, the last 7 Fridays have all been negative. They've all been red, and they've averaged a decline of about 1.5%. So not really much to draw from that about Thursday's rally and Friday's decline, just more so that short-term retail traders are very nervous in this environment, and they really don't want to hold stocks over the weekend. So what happens last Friday? Market gets pounded, and then we have a big rally on Monday and into Tuesday. So as of right now, depending on what markets do today, markets are looking at a positive week, the best week since July. This is where we closed yesterday. Right now it is Friday morning before markets open, so we'll see where we go. But as long as we close above this level down here, which is about 10,300 on the NASDAQ, markets will log a positive week, and I think all of us will take any positive week that we can get at this point. Over the last month, markets just very unsure about where they want to go, right? We were on the top end of the range, we were at the bottom end of the range, but really when all was said and done, we really haven't done much moving. Okay, and sometimes that's not the worst thing when markets have been so volatile. We continue to see an unprecedented rise in rates. Bond yields pushing mortgage rates higher. National average on a mortgage rate 30-year now is for a medial credit score is now over 7.2%. So those chickens will come home to roost soon enough, as we all know that the real estate market works with a lagging effect. Want to share something new with you this week, something that we've came up with. As you know, we're always trying to refine our research and analytics and to present them to you in a way that's easy to understand and follow along with. So we have come up with our equity risk gauge. This is something we're going to be updating once a month. We're going to be sharing with you, obviously, in these videos. And of course, we'll reference this in meetings and such when folks come in. But basically what we're doing here is we're taking a look at the economy and markets from a variety of different perspectives, right? These are all the different perspectives up top, looking at sentiment, looking at seasonals, valuations, technicals, and on and on and on, right? You can read. I don't need to read it to you. And what we're doing here is assigning a score, right? Is this basically a bull indicator or a bear indicator, or could it potentially be neutral? So when we look at the lay of the land right now in financial markets, things don't feel very good, but it's not all bad, right? And that's why we wanted to come up with this to show you. Here's what our tailwinds are, and here's what our headwinds are. So let's go through this. When we look at sentiment, right, mood of the market, right, how do investors feel? Investors feel terrible, right? They're just so negative, they're so bearish. And that is a net positive for markets, right? Because excess of anything in markets tends not to last. So we have excessive bearishness right now, and bears or the naysayers on this market are just overly confident, right? They are guaranteeing a crash is going to happen, and the financial market is really not the place to make guarantees. So as far as sentiment goes, it is so negative Contrarian thinking says this is a positive. Now, when we look at seasonals, right, what part of the year are we in, right? What part of the calendar? Seasonal impacts certainly have effect in markets. We know we're in Q4 now, and Q4 tends to be the best quarter of the year. It tends to be bullish. We're also going to enter into year 3 of the election cycle, and I'm going to touch on the election cycle in a moment. It's very important, something we want to convey to you about that and about how reliable these cycles have been. But on the positive side of things, sentiment is in our plus column, and so are seasonals. As far as valuations in the market, they're mixed right now. Valuations have come down a lot, so they are getting more attractive. However, when we look at risk-free rates, right, like U.S. Treasuries and things of that nature, which have zero risk if you hold to maturity, they're paying some pretty hefty rates right now, folks. And that's an aside here. You know, for those of you sitting on a lot of cash in the bank, U.S. Treasuries paying 4.4, 4.6% for 1 or 2 years, risk-free, folks. So keep that in mind. Next time you're looking at a CD at the bank for 1.5%, there are better alternatives out there. As far as the technicals of this market, there's a clear downtrend in place, right? We know that, but markets are very, very, very oversold. So we should get a bounce here, whether it's a lasting bounce or just a short-term bear market rally. The technicals suggest we are very oversold. As far as the economy is concerned, now remember the market 6 to 9 months ahead of the real economy. So the market has priced in all this doom and gloom and Armageddon, and now it's starting to show up in the real economy, right? Our leading indicators are starting to fall, and the housing market is likely going to be in trouble if interest rates stay at these levels or continue to go higher. As far as the market cycles, we know we are in a bear market, and we are getting close to that bear market average decline, but we're not there just yet. I'll have more on that in a moment. And then, of course, the Fed and financial conditions, which is the number one driver of this whole thing. The Fed remains aggressively hawkish and financial conditions remain tight. So, in summary, right, when we look at what are our current tailwinds for this market, we're in a very strong seasonal period. Investors are overly bearish and markets are extremely oversold. And then our headwinds, right, we still have a hawkish Fed, no change there. The downtrend in this market feels very entrenched. It's going to take some really, really heavy work to push through and out of this. We have weak internals and the economy is weakening. So, sentiment, we know that. We talked about that. Sentiment is very negative. But let's look for a second at seasonality and particularly the election cycles, because I think this is very much overlooked and it's very important. So there's tons of data about presidential cycles, and markets tend to behave differently in different years of the presidential cycle, right? Generally, years 1 through 4, you get different results. Now, when we look at seasonality, okay, and apply it to the presidential cycle, here is what we find out, okay? Number one, the worst year of any president tends to be year 2, right? And right now, Joe Biden is in his second year. The worst quarter of any year for a president tends to be second quarter of year 2. So far, that held up, right? Second quarter this year was awful. The best point or the best period of time to be an investor based upon these trends is starting in the fourth quarter of year 2 through the third quarter of year 3, right? So, folks, basically the next 9 months under any president is the best time to be invested. Now, to put this into a visual, here, this chart on the bottom here is our 4-year presidential cycle. And, folks, we are right here, okay? Now, again, history is a guide. We should be buying this market at these levels. Clearly, right, we're in uncharted waters. There's a lot of things going on, so it's not that simple. But I would not be a seller of this market here and now based upon the presidential cycle. And this goes back probably about 100 plus years of data showing this, all right? And the gains from the beginning of Q4 of year 2 to the end of Q3 of year 3 have averaged about 25% going back over 100 years. So that's something we want to keep in mind and we want to point to. And then when we look above here, right here is the average of all years put together. So the midterm years are in the red here. And, we really haven't spent any time in positive territory for the market this year. But for the most part, it has been pretty accurate, where we see weakness into June, a rally into August, more weakness into October. Here we are. And let's see if we get that year-end rally that we all are desiring at this point. I'm not going to bore you with all the valuations, fundamentals, and technicals. As far as technicals go, right, the market is within these red channels here. This is a downtrend that's entrenched. And at some point, we will break through the upper bound of this channel, which will signal that the market is undergoing a mood change and that higher prices are on the way. We have spent about 131 days consecutively below the 200-day moving average, which is this gray line here. And now this is something that we look for, right? The longer you stay below the 200-day, the more difficult it is to get above. But once we do get back above, a new uptrend will be born, like you saw right here in May of 2020. The S&P retook its 200-day moving average and stayed above it for the better part of the next 18 months. So let's fast forward to the end. In summary, right? When we're looking at these markets, and we've had a lot of conversations with you folks about it, really good chats. People have a lot of great questions. And, you look at the declines here and say, how are we going to climb back from this? How is America going to climb back from this, right? The S&P is down 25%. NASDAQ is down 30%. How are we ever going to pull ourselves out of this hole? Well, folks, we have to look at history as a guide. So when we look at historical bear markets, right, we know the shortest bear market was March of 2020, 33 days. But that's generally not how these things play out. The average bear market lasts about 286 days. Okay, folks, we're at 283 days right now. So for historical averages, we are right there. The longest bear market ever was in the 70s. That was about 600 days. So if we're going by that analog, we're only halfway there. But we don't think that that is the example to use. The shortest and the longest tend to be anomalies. Let's look at the median. That's about 286 days. On average, bear markets decline about 35%. Now, this current bear market has declined about 26%. So from a price perspective, we're not there yet, but there's no guarantee that we have to go all the way there. But what comes after bear markets? Bull markets, right? So let's take a look at some statistics from bull markets. When we look at the average length of a new bull market, folks, it's about 1,000 days, right? So almost 3+ years of gains. I think we'd all sign up for that right now. And when we look at the average gains in those bull markets, right, that average 1,000-day gain, about 113%, okay? So just think about the money you have invested right now. If it doubled over the next 3 years, how would you feel? Would you feel great? Would it put you back to new all-time highs? We know the answer to that question is yes. So hang on, hold tight. Bear markets are not a malfunction of markets. They are a feature of investing in markets. But what follows every bear is a bull. What follows every bull is a bear, right? This cycle is unchanged through history, and it's not going to change here and now in 2022. So we hope you enjoyed the Heritage Equity Risk Gauge. Let us know what you think. You send me an email, drop a comment. We're always interested to get your feedback. Again, everything we do is for you, to try to bring you along, give you a look behind the curtain, and show you what we see with data that's easy to view and understand. So we hope you have a great weekend. If you have any questions, reach out to us. We'll see you back next week for a Heritage Market Update.